Hi, welcome to Chapter 9, Hospitality Accounting. We're going to talk about restaurant accounting and financial analysis. It's very important to understand accounting when you're managing a restaurant or a hotel. Restaurant owners and managers must have enough knowledge and understanding of accounting to make good business decisions. So it may sound like a good idea to just let your accountant take care of it, but if you can understand the consequences and the information that you're looking at, then you're at risk. And also understanding reports and making sound decisions will make you a better employee and more marketable. So if you can go in and prove that you understand the reports and make decisions that improve profitability based on them, you'll be a better employee, and you'll be more marketable, you'll be up for promotions, and that's where you want to be. So when you talk about food sales accounting, we include the sales of food, so steaks, burgers, salads, all of that kind of stuff. We also include coffee, tea, milk, and fruit juices and food sales. When you're doing accounting, it may be helpful to add subcategories for more analysis. It says, for example, baked goods are part of your business. Perhaps you should create that subgroup so you know you're getting the appropriate profit margin there, especially if you're not baking in-house. If you're pulling it from another business and you're charging a markup, you want to make sure that it's appropriate. Accounts should be tailored to the needs of the business. So if you don't have bakery goods, it doesn't make sense to have a bakery goods sub-account. Perhaps you want to say, this is my salads, this is my entrees, these are my sandwiches. So whatever information helps you to analyze your business. And when you're coding things into a computer system, you can put in these subcategories so that the computer is keeping track, so there's no additional bookkeeping, and then you can run reports, so that's helpful. Also, coupons and other discounts should be tracked. They should be tracked separately. And a contra account, remember contra means opposite, so that you can be aware of how much of a discount you're giving. You know, it may sound like a good idea to do Groupon, get a lot of customers in, and then you may find once you do the analysis of the Groupon coupons that you are not making enough money to make that promotion worthwhile or a good promotion for your business. Now, beverage sales accounting, similar to food sales accounting, only we're looking at beverage sales, include alcoholic beverages and soft drinks. Beverages are tracked separately because they have a different markup. So generally, you're probably going to have a better markup on alcohol and soft drinks than you do on their food. And they have a longer shelf life. You don't have as much spoilage and shrinkage because they last longer. Additionally, this is a good place to market. When you go into a restaurant yourself, you may go and right away on the table they're going to have a lot of advertisements for happy hours, for fancy drinks, glossy pictures. They're trying to get your business because those things do have a good markup. Cost of sales, we've talked about this before, especially when we were talking about the income statement, but cost of sales for food and beverages are accounted for independently, and they represent the cost of food or beverage used to generate a customer sale. So whatever it costs you to buy the lettuce, the cucumber, the tomato, the cheese, the croutons, the chicken, whatever goes on the salad, those are the cost of food. And for beverage, you know, if you're buying beer, then you go to the beer distributor and you mark it up. But if you're making something like a milkshake, then that would have different costs associated with that as you're making it. Cost for food for employees should be reported separately. Most restaurants do make sure that their employees are well aware of what the food is, that everyone's tasted it, they know how it should look when it's prepared, etc. But the cost of educating your wait staff on your food should be recorded separately. If we're talking about a fast food organization, fast food restaurants will include paper, wrappers, napkins, takeout containers, plastic utensils and straws, and the computation of cost of sales. Obviously, when you go to McDonald's, they're giving it to you in a paper wrapper or a plastic container. You're never going to get it on a plate. So that becomes part of the cost of selling the food in a fast food restaurant, because that is how it comes. There's two types of inventory systems. One is the perpetual system, the other is the periodic inventory system. Remembering that inventory is the food and beverages that are available for sale to your customer. That's what inventory means. It's available for sale to customers. Again, there's two systems. The perpetual system is like what we see at Walmart or Giant Eagle, with the barcode and things are scanned. It continually updates inventory levels, but record keeping can be extensive. Smaller operations may not use this system. Because your food does not have barcodes on it, you can't scan a hamburger, you can't scan a steak. Many smaller operations may not use this system because it requires more record keeping. A periodic inventory system uses a periodic count of inventory. So we know how much inventory we have, we know how much inventory we bought, and then we go and count the inventory and know how much is left, and we can calculate or deduce what we sold. Inventory levels are not known until a count is done. So especially in food, you may find that inventories are done for a periodic system very regularly, or even in a perpetual system you find that inventory counts are done very regularly, and that is to have a safeguard of your assets, safeguard of your inventory. If you've ever worked in a restaurant, you may know that they count food items or that they count alcohol actually at the end of every night. And some of that is for a periodic count to record inventory, and some of that is a safeguard of assets. It's asset management. Talk about some operating expenses. Operating expenses relate to the direct day-to-day operations of the business. So we have salaries and wages. I don't think I need to explain that. Employee benefits, 401k, health, vision, anything there would be an employee benefit. Music and entertainment. If you're booking a band, you're paying for any type of entertainment. You have a juggler come in on family night, that would be an operating expense. I have your marketing and advertising. Sometimes people lump them together. They're really quite different. So anything you're doing for marketing or any advertising you're doing should be recorded here in operating expenses. Then we have utilities, things like heat, water, gas. Repairs and maintenance, you need to keep your facility looking nice. So repairs would be if a pipe broke, if a window is damaged, carpet got ripped. And maintenance is more the things you do to keep things looking nice. Painting, cleaning the gutters, maintaining the landscaping outside. That's all maintenance. Occupancy is expense. That deals with having the actual property, so that would be rent insurance, property taxes. If you weren't renting, then we could take out rent and rent insurance and put in mortgage or just homeowners insurance. So those are occupancy expenses. Then we have depreciation. Depreciation will be covered in a later chapter, but it deals with long-lived assets. So we're just going to wait until we do the entire chapter on depreciation. And then we have administrative expenses. So things like papers, pens, the computer, copy paper, paying your bookkeeper, your accountant, all of those would be considered administrative expenses. Some other things that are on a restaurant balance sheet that you might not see on other balance sheets is china, glassware, silver, linen, uniforms. So of course your china, your glassware, your silverware, and your tablecloth, all associated with the table, was not very common in other businesses. And then uniforms for your wait staff oftentimes are provided so that everyone looks the same and has a nice look of crispness to your restaurant. Pre-opening expenses are things that you have to pay for before you open the doors. You are allowed to hold them as an asset and then expense them over 12 months. Cost of a bar license. Most places require you to pay fees to serve alcohol, so that would be there. Any other type of fee that would be required for your establishment by local or state ordinance would also go here. And franchise costs. Many restaurants are franchises: Applebee's, Fridays, McDonald's, Chick-fil-A. And the way they work is you pay at least a one-time franchise cost, and then usually costs every month. But that one-time franchise cost you report as an asset and then expense over time. So we have some ratio analysis we're going to talk about here. There's quite a few ratios in Chapter 9, and the ratios will allow you to do analysis to understand how your business is performing. In general, looking at the ratio just by itself is not helpful. Usually what you want to do is you want to compare it to another ratio. So you might want to compare it to last year or last month. You may want to try and compare it to other restaurants in the area if you can get that information. Sometimes through the use of trade journals, you can get some benchmarking information from other restaurants of your type and size. So first of all, we have cost of food percentage, and that measures the cost efficiency in generating customer sales. So we take the cost of our food and we divide it by our food sales. That kind of says, okay, if I'm charging $10 for this meal, how much did it cost me and what percentage is going to be my cost? Obviously, the flip side of that is your profit. So the higher your food costs compared to food sales, the lower profit or money you're making in your business. Obviously, you have to walk a fine line there. Customers are not going to overpay, especially since there are often many, many restaurants for them to choose for their business. But on the other hand, you don't want to be undercutting your profit margins to the point where you're not making any money and working very hard. Sales mix is the relationship of an element to the sales total. So you would take an item, let's just say the hamburger, and divide it by total sales. And you can see what the percentages of sales that people are buying a hamburger. And this may help you to eliminate unprofitable items or items that aren't purchased very often from your menu. Items that aren't purchased very often on your menu will have increased carrying costs for your inventory. You may have increased spoilage and shrinkage there because you have to throw them away because you couldn't sell them. So that's an important ratio. Food sales analysis by meal period is helpful in determining whether a particular meal period warrants being open for business. So are you going to be open for breakfast, lunch, and dinner? What are your periods for breakfast compared to dinner? What is that percentage? Does it make sense to be open for breakfast? Or does it make sense to be open for dinner? You know, if you are a restaurant located in downtown Pittsburgh, you probably are not going to get as many sales for dinner as you might for lunch. You may want to decide how late you're going to stay open so that you're not paying wait staff to stand around. Some more ratio analysis here. The average food check shows on average how much a guest is spending. Obviously, the more they spend, the more money you'll make. The average food sale per seat is computed using the total number of seats. So no matter how many seats you have, and if anyone is sitting in them, that is the number you use. Your space may be too big. You may be paying rent on a space that you don't utilize, that you don't have enough customers. So you could pay less rent and actually make more money. So that's average food sale per seat. Oops. And then seat turnover is the number of times the seat is occupied. I'm sure that we've all gone to dinner at a busy restaurant. We've had to wait until someone leaves. That's seat turnover. Obviously, the more times the seat is turned over, the more sales are generated. Beverage ratios are similar to sales ratios, but we have some different ones here. One is beverage to food sales ratio, and we compare how much our beverage sales are to food. This can be very important since beverages have a high profit margin, especially places like Fridays, Applebee's, Olive Garden. If they can get their beverage sales up, then they have more profit. And also we want to look at beverage sales by type of drink. You want to do some analysis there because different drinks have different profit margins and you can make more money if you are advertising or selling, or the wait staff is suggesting drinks with a higher profit margin. I'm running out of time, so I'm going to quickly tell you thank you for watching. I look forward to seeing you in WINBA, and please be sure to read Chapter 9 of your textbook. Thanks.